I think it's all of that. There's the nervousness about whether they'll get paid if they hold government bonds. And I'm not talking about a default. The US government is not going to default, but you're not going to get paid in cash, which could buy the same amount 10 years from now as it can buy today. That's for sure. So you'll get paid in either a devalued currency or potentially a worthless currency, or potentially a restricted currency. What's a restricted currency? It's a currency which you can't use in the way you want to use it. There are analogies like that. I mean, if I give you an example, in the UK during and after the World War, they had what's called Russian coupons. You could be a multi-millionaire, but if you want to buy a pound of butter, you had to have a Russian coupon to go with it. So what's the real currency here? Is it the £1 million you got in the bank, or is it what you're allowed to spend, the Russian coupon? So that's just an example of the way it might go. But the reality is this: if you hold a lot of cash, money market funds, deposits, or bonds of any description, they're not going to buy you what they can buy you today, a decade from now. So I think there's a general tendency for people to move away from that asset class towards other things. And that's why the stock market's doing so well. It's why Bitcoin's done so well. It's why gold and silver are doing so well. It's even why the property market, ignoring commercial real estate, is doing so well. People are trying to move into other things to protect themselves against the devaluation of the currency. And I think that with the level of debt, of the government debt rising faster and faster, I think that trend will continue. And I think the gold price is signaling there's a general malaise about the ability to get repaid in something worthwhile down the line. So people are moving into, it's not people moving into gold. I think it's the foreign central banks, but to a little extent, people are starting to put gold into the portfolios. I mean, when I retired 3 years ago, the official asset allocation of most banks for gold was zero. I've seen a number of very large institutions come out and say gold has moved from an unwatched asset class to what they call their most preferred asset class. So I think that's driving the gold price upwards as more and more institutions start to put it into their asset allocation.
Yeah, and they're vastly underinvested over the past, really since 2008. I think there was this big boom up into 2008. After that, it sort of went down, and since then they haven't, institutions, even sort of funds, etc., haven't invested in precious metals really over that period.
I mean, look at it like this: if you own an ounce of gold, 10 years from now, 100 years from now, it will still be an ounce of gold, and it will still buy what an ounce of gold buys today. You own a treasury bond. Do you know what that will buy in 10 years? Well, we don't know, but I know it's going to buy less, and probably with the speed things are going, probably a lot less. And I think that's the general feeling. And of course, central banks around the world are reducing their whole exposure to the US dollar. It's currently globally, it's currently at 57%, which is the lowest level in 25 years.